The Tariff Trap: How Customs Duties Became America's Shadow Tax Before 1913. In 1890, a quiet revolution happened at the port of New York. Not a protest, not a law signed in ceremony, a spreadsheet changed. The clerks who calculated what Americans paid on imported goods received new instructions, and within months, millions of dollars flowed into federal coffers that had never been counted as taxation. Nobody called it a tax. That was the entire point. And by the time anyone understood what had actually occurred, the mechanism was too embedded to remove. I'm going to show you how this happened, and more importantly, why it worked. Because the real story isn't about tariffs at all. It's about how to hide a tax in plain sight. If you've ever wondered why your great-grandparents might have had strong opinions about trade policy, or why political careers lived and died on commodity duties, this channel exists to answer those questions. Subscribe, because we're building a complete picture of how money and power moved through America before the income tax gave everything away. And leave a comment below. What's the oldest piece of family financial history you know about? Did your ancestors run a business, work in factories, or move because of where jobs were? Those decisions lived inside tariff policy. Now, hold on. This part is crucial, so I need your complete attention for just a moment. The mechanisms that built tariffs into the economic bloodstream of America before 1913 weren't accidental. They were engineered. And every pattern, every network, every political arrangement that made it possible is documented in congressional records and trade committee minutes. We've assembled a complete guide to tariff architecture, the families who profited from it, and the legislative smokescreens that hid it all. You'll find it in the description and pinned comment. It goes far deeper than video allows, because understanding how tariffs actually worked requires seeing the blueprints themselves. Here's what the history books skip over. Before 1913, the federal government had almost no income tax. That's not missing context, that's the entire foundation. The United States ran on tariff revenue. From 1860 through 1912, customs duties provided somewhere between 40 and 55% of all federal income, sometimes more. That wasn't incidental financing. That was the design. A merchant in Philadelphia paid a tax every time he imported cloth from Manchester. A shopkeeper in Boston owed money when English tea arrived. A farmer in Ohio who bought tools manufactured in Scotland, that blade, that implement, that machinery, carried a hidden cost that never appeared on any receipt. It was calculated at the dock, paid before goods left customs, and recorded in ledgers that no ordinary citizen ever saw. The tax was invisible because it was embedded in prices. By 1890, something shifted. The McKinley Tariff, passed that year, didn't invent the system, but it perfected it. The rates climbed. A silk dress that cost $2 in Paris cost $4 in Philadelphia. Cotton fabric from India faced duties so steep that domestic mills could charge whatever they wanted. American manufacturers, safe behind this wall of cost, never had to compete on quality or efficiency. They simply raised prices. The consumer paid. Nobody called it taxation because it wasn't labeled that way. The brilliance wasn't the tariff itself. Every nation protected its manufacturers. The brilliance was the scale. America's tariff rates in the 1890s were among the highest in the world, sometimes 60, 70, even 80% on finished goods. A British observer in 1895 calculated that an ordinary American family with modest income spent roughly a quarter of their earnings on tariff-inflated prices, whether they bought imported goods directly or American products priced up to match imported competition. That was a tax. It was just never called one. The politicians who championed tariffs never framed it this way. They called it protection for American workers. The Homestead Works in Pennsylvania, the cotton mills of New England, the iron foundries of Ohio, these industries did employ thousands. That wasn't false. But what went unstated, what was actively obscured, was the price paid by everyone else. The farmer who bought expensive tools, the family that wore expensive cloth, the housewife who paid more for sugar because tariff walls kept out competition. And here's where it becomes genuinely complicated. Some workers did benefit. Steel mill operators saw wages rise in the 1880s and 90s because tariff protection meant mills could expand and pay more. Textile workers in Lowell, Massachusetts had steadier employment because tariffs choked off cheaper imports. These weren't imaginary gains. Real people built real lives on tariff-protected wages. The trap wasn't that the system created no benefits. The trap was that those benefits were concentrated while the costs were distributed across the entire population. Hidden, systemic, and impossible to organize against. The political consequence was astonishing. Once tariff revenue became the federal government's primary income source, any politician who threatened to lower tariffs was essentially threatening to cut government spending, reduce military capacity, or impose income taxes, which nobody wanted. The tariff wall had become a political cage. Lower it and something else had to give. Raise it and manufacturers, workers, and their allied interests supported you. The system was self-reinforcing. By 1905, McKinley was dead and Theodore Roosevelt had taken office. Roosevelt, for all his populist rhetoric, never seriously dismantled the tariff. Why would he? The federal government depended on it. The Republican Party depended on it. So did the Democrats in some districts where protected industries dominated. The tariff wasn't a policy you could debate away. It was structural. This is exactly where the story becomes interesting, because what happened between 1905 and 1913 wasn't a slow evolution toward reform. It was a collision. New forces were emerging that tariffs couldn't contain anymore, and the solution that finally replaced them would reshape American power entirely. Between 1905 and 1913, the tariff system faced a problem it couldn't solve by itself. The economy was changing. Industrial capacity had exploded. American manufacturers no longer needed the same level of protection they once did. Many of them had become so dominant that tariff walls actually worked against their interests now. A steel company that dominated domestic production didn't want a high tariff on raw materials. A textile manufacturer already outselling British competitors didn't need customs duties to survive. They needed something different. They needed credit, currency stability, and the ability to move capital internationally without friction. The railroads felt it most acutely. By 1906, the railroad industry had matured into a complex web of mergers, holding companies, and financial instruments. A single transcontinental line might span 15 states, employ 50,000 workers, and owe money to banks on 3 continents. Tariffs on steel and coal helped manufacture rails, but they didn't help a railroad company that needed to refinance its bonds or access foreign capital markets. The old system had created wealth for the first wave of robber barons. Now their sons and their bankers needed something new. Then came 1907. The financial panic of that year shook American capital markets in a way that tariff policy could never address. Suddenly, the weakness was obvious. The United States had no central bank. When credit dried up, there was no mechanism to inject liquidity into the system. State banks couldn't coordinate. The Treasury Department had no power to act as a lender of last resort. The panic nearly destroyed the entire financial system. J.P. Morgan, the most powerful private banker in America, personally stepped in to organize a rescue. Morgan and a handful of other bankers essentially became an ad hoc central bank for 3 months. They called it crisis management. What it really was, proof that the federal government had surrendered its monetary authority to private bankers. And everyone who mattered knew it. This is the crucial moment. The panic exposed a contradiction that tariffs couldn't hide anymore. The federal government depended on tariff revenue for most of its operating budget, which meant it couldn't regulate the currency or create a central bank without finding a replacement revenue source. But finding that replacement meant confronting something the tariff had protected for 50 years, direct taxation of wealth. Between 1907 and 1910, the conversation shifted in ways that seemed subtle on the surface, but were revolutionary underneath. Politicians began discussing a federal income tax as a serious policy option, not as a radical experiment, but as a practical solution to a structural problem. Before we continue, I need you to understand something important here. This wasn't populist pressure from below. The architects of this shift weren't reformers demanding fairness. They were bankers and industrialists who had decided that the tariff system, for all its benefits, had become an obstacle to their real interests. The money was increasingly in finance, not manufacturing. Control required a different apparatus. The 16th Amendment, which would authorize an income tax, wasn't radical at all when you understood its real purpose. It wasn't a way to redistribute wealth downward. It was a way to replace tariff revenue while simultaneously creating a new tool for federal control: the Internal Revenue Service, the income tax forms, the machinery of direct taxation. It gave the federal government something the tariff never could: intimate knowledge of every substantial business and wealth holder in the country. Tariffs were blunt. Income taxes were surgical. The tariff had been a tax on imports. Simple. Foreigners paid it, or your competition did. American workers and manufacturers could understand it. But an income tax required reporting, auditing, and enforcement. It required the federal government to know your business in detail. It required access to bank records, ledgers, correspondence. Frankly, this is the part that still bothers me when I study it. Not because income taxes are inherently wrong, but because the way they replaced tariffs wasn't a democratic choice. It was a financial architecture redesign sold to the public as reform while actually consolidating power in the hands of those who understood the new machinery best. By 1912, the intellectual and political groundwork was complete. Both major parties accepted that the tariff would fall and income taxes would rise. The difference between them was only in degree and timing. The election of 1912 turned on this pivot. Theodore Roosevelt had split the Republican Party. William Howard Taft held the conservative faction. Woodrow Wilson, a Democrat, promised tariff reduction and progressive taxation. He won with 40% of the vote, a plurality, not a mandate. Yet he possessed something more valuable than a majority. He had intellectual cover. Progressive reformers believed in him. Labor unions believed in him. Middle-class voters who resented industrial monopolies believed in him. None of them understood that the machinery they were voting for would eventually concentrate financial power more effectively than the tariff system ever had. Two things happened in 1913. The 16th Amendment passed, officially legalizing income taxation, and the Underwood Tariff slashed import duties. Tariff revenue collapsed from over 40% of federal income to less than 10%. Income taxes filled the gap. The Federal Reserve, chartered that same year, became the mechanism through which this new tax revenue would be managed and expanded. But here is what the textbooks omit. The architects of this system, and I mean the bankers, the corporate lawyers, the railroad men who sat in the rooms where these bills were drafted, they understood something the public did not. An income tax doesn't actually replace a tariff. It supplements it. It fragments it. It makes it invisible. Before we continue, I need you to grasp something critical about how power actually transferred in those years. The mechanisms, the triggers, the institutional designs, the loopholes written into law, they're all documented, but they're scattered across congressional testimony, banking records, and correspondence most people will never read. That's precisely why I've assembled a complete guide that walks you through each piece of this machinery. You'll find it in the description and pinned to the top comment. It's not free, because this level of detail required original research and cross-referencing primary sources. But if you want to understand not just the tariff system but the entire architecture that replaced it, that guide is where all these threads come together. Now, the tariff had been a visible tax, everyone knew it existed, manufacturers lobbied against it openly, workers debated it in newspapers, politicians ran for office on tariff platforms. It was ugly, often, but democratic in form. An income tax was different. It was progressive in theory. The wealthy paid more in absolute dollars. But the wealthy also had access to accountants, lawyers, and tax strategists. They could structure their income in ways ordinary people could not. They could move assets across state lines. They could establish trusts and holding companies. The federal government, meanwhile, had no real experience administering a direct income tax. No infrastructure existed. No clerks trained in assessment, no courts experienced in tax disputes. That job fell to private banking institutions. J.P. Morgan's Bank, the National City Bank, Kuhn Loeb and Company, they became, in effect, the collection agencies and financial advisors for federal tax policy. Not officially, never stated, but functionally, yes. They processed payments. They held reserves. They interpreted regulations. They shaped how the system actually worked on the ground. A manufacturer in Pennsylvania, with tariff duties to pay, could see exactly what he owed. A businessman owing income tax had to rely on a bank, an accountant, or a lawyer to calculate it. The point of collection had shifted from the border to the interior, from a simple visible transaction to a complex mediated one. And whoever controls the mechanism of mediation holds genuine power. By 1914, the first income taxes were being assessed. The rates were low by later standards. A worker earning $2,000 annually paid nothing. Only above $3,000 did any tax apply. But the principle was established. The infrastructure was in place. And the men who understood how to navigate that infrastructure, the bankers, the corporate attorneys, the accountants, they had become indispensable to the functioning of American capitalism. The tariff had protected American manufacturers from foreign competition. The income tax, as it evolved, protected bankers and corporate lawyers from public scrutiny. That was not coincidence. It was design. Before we continue, keep this in mind for a second. The architects of American finance were not men who needed to hide in shadows. They operated in plain sight, within institutions they had themselves designed. If you want to understand the exact mechanisms by which private banking interests shaped federal tax policy, the specific mechanisms, not the broad strokes, that requires documents most people never access. The complete guide to pre-modern American financial engineering sits in the description and pinned comment. It walks through the declassified correspondence, the congressional testimony transcripts, and the banking records that prove this was systematic, not accidental. This guide is a paid resource, but if you're serious about understanding how American power was actually constructed, it's where the real evidence lives. Now, here's what becomes crucial in the years immediately following 1914. The income tax existed, yes, but the machinery to collect it, audit it, and enforce it did not yet exist. Congress had written the law, but who would administer it? Who would define how it worked in practice? The Treasury Department was small. It had collected tariffs at ports for over a century. But tariff collection was straightforward by comparison. A customs officer weighed goods. He applied a rate. He collected money. The paperwork stayed at the port. Income taxation required something far more elaborate. It required a national bureaucracy that simply did not yet exist. It required forms. It required inspectors who could travel to every city and town. It required rules for what counted as income, what could be deducted, how to handle corporate profits versus personal wages. Congress could pass a law, but the Treasury Department had to write the regulations that made it real. And who did the Treasury consult? Who sat in those offices and shaped the rules? The men who had been managing American finance for decades. The bankers, the railroad attorneys, the corporate accountants. The same networks that had shaped tariff policy now shaped income tax policy. The venue had changed. The cast of characters remained remarkably stable. A man named Edwin Seligman became one of the most influential voices in shaping early income tax administration. Seligman was a Columbia University economist. He was also a confidant of presidents. When the Wilson administration needed advice on how to structure the tax code, they called Seligman. When the Treasury Department needed guidance on how to administer it, they consulted Seligman. And Seligman, despite his academic credentials, spent much of his career advising wealthy clients on how to minimize their tax exposure. He was not primarily a public servant. He was a private expert whose public influence derived from his connections to power. The pattern repeats itself. The same people who shaped tariff law shaped income tax law. The men who profited from the tariff system now positioned themselves to profit from the income tax system, not by paying less themselves necessarily, but by becoming indispensable to those who needed to pay it correctly. The accountants, the lawyers, the bankers, they became the interpreters of federal financial law, and interpretation is power. By 1916, the first income tax returns were being filed. Over 400,000 Americans submitted returns that year. That was tiny compared to later standards, but it was revolutionary at the time. And each return required someone to fill it out. Each return required consultation. Each return generated fees for lawyers, accountants, and tax advisors. A new market had been created, not by innovation, by legislation, by institutional design. The tariff had been a tax on goods, visible at the port, borne largely by consumers who saw prices rise. The income tax was different. It was a tax on individuals and corporations, mediated through complex paperwork and professional advisors. The burden was diffuse. The process was opaque, and the men who controlled the process had positioned themselves as essential to its functioning. What the public did not understand, what most Americans still do not understand, was that income taxation did not weaken the power of finance capital in America. It reorganized it. It gave bankers and lawyers a new jurisdiction. It created a permanent relationship between government and the financial professionals who could navigate the tax code. The tariff system had made manufacturers wealthy and protected. The income tax system made financial intermediaries necessary. One enriched the production side of the economy, the other enriched the mediation side. Both served the same underlying purpose, concentrating wealth and power among those who controlled the mechanisms through which it flowed. By 1916, the income tax had generated enough revenue that tariffs could theoretically be lowered. They weren't. Instead, both systems ran in parallel. A manufacturer paid tariff protection on imports. A banker paid income tax on profits from financing that manufacturer. The government collected from multiple points in the same economic chain. What looked like a reduction in protectionism was actually a multiplication of extraction points. The architects understood this completely. They had designed it that way. Consider what happened to railroad financing in this period. Before 1913, railroads had been the primary vehicle for concentrating capital in private hands. J.P. Morgan and his network had built entire industries by controlling the flow of railroad bonds and stock. The income tax did not eliminate this. It legitimized it. A railroad promoter could now pay income tax as an American citizen while conducting business in a way that would have drawn congressional investigation 10 years earlier. The tax code provided cover. The filing requirement itself became a tool of control. Starting in 1916, anyone earning above a certain threshold had to file a return. This created a permanent record. The government, meaning Treasury officials, many of whom were drawn from the banking and legal professions themselves, now had documented evidence of who earned what and from where. That information could be used. Not always publicly, not always formally, but it could be used. A railroad executive who resisted a particular policy proposal might find his return audited. A manufacturer who refused to cooperate with price fixing might face questions about his deductions. The power was implicit, and therefore rarely needed to be exercised. The existence of the system was enough. Before we continue, keep this in mind for a second. The real architecture of American financial control was never just about law or policy. It was about creating systems that made certain behaviors inevitable and certain actors indispensable. The income tax system did exactly that. It made accountants, lawyers, and tax specialists essential to every transaction above a certain size. Those professionals became a permanent class of intermediaries between citizens and the state. And that class had every incentive to keep the system complex, opaque, and ever-expanding. If you want to understand how this entire machinery actually worked, how the connections between tariff policy, income tax design, banking regulation, and political power really functioned, the complete guide to this era is available in the description and pinned in the comments. It lays out the full mechanism, the signals, the pressure points, the way each policy fed into the others. This is the kind of detail that takes time to explain properly, and it's all there. The income tax also solved a problem for the banking interests that earlier tariff systems had created. Under pure tariff protection, the economic surplus flowed to manufacturers and railroad owners directly. It was distributed through their networks, their families, their associates. It was visible, it was concentrated. Eventually, enough people noticed that it invited political backlash. The populist movements of the 1890s had proven that. The income tax diffused and obscured that concentration. Yes, wealth still flowed upward, but now it flowed through a more complex set of channels. Corporate profits were subject to taxation, but corporations could be structured to minimize that. Capital gains received different treatment than wages. Bonds yielded interest that was taxed differently than dividends. Within this labyrinth, the same wealth that would have been obviously concentrated under pure tariff protection could be distributed, hidden, reorganized, and reconcentrated with far less public visibility. By the early 1920s, this had become the standard operating procedure. A wealthy family would own stock in a holding company, which owned shares in operating companies, which held bonds issued by subsidiaries, which invested in real estate trusts. Each layer had different tax treatment. Each layer created an opportunity for a lawyer or accountant to earn fees by structuring it correctly. The total wealth remained concentrated at the top. The path by which it got there had become nearly impossible for an average citizen to trace. The architects of this system, and I mean the actual financial engineers and legal minds who built it, were now permanent fixtures in American governance. Treasury secretaries came from banking backgrounds. Federal Reserve officials maintained private banking interests. Congressional committees on taxation relied on testimony from tax specialists who had clients in the industries being regulated. The revolving door between finance and government, which had existed under the tariff system, had simply been upgraded. It was more efficient now, less obvious. And so we arrive at the revelation I promised you at the beginning of this video. The tariff trap did not disappear in 1913. It transformed. When the income tax arrived, Americans believed they had finally found a direct, visible, democratic way to fund government. No more hidden levies buried in the price of cloth or steel. No more fortunes made by the men who controlled what goods crossed the border. The income tax promised transparency. It promised fairness. It promised that wealth would be taxed at its source. What actually happened was different. The architects I have named throughout this script, the banking families, the railroad lords, the legal minds who had spent decades learning how to move money invisibly, simply adapted their methods. They did not fight the income tax head-on. They shaped it from within. They wrote the deductions. They defined what counted as income and what counted as capital. They created the holding companies and the trust structures and the cross-ownership arrangements that would allow a man to be vastly wealthy while paying almost nothing to the government that protected his wealth. The tariff had been a visible cage. You could see it. You could measure it. A farmer in Ohio knew exactly why a British textile cost more than an American one. A merchant in Boston could calculate the tariff's impact on his ledgers. The income tax became an invisible maze. The same result, wealth concentrated, the many paying more than the few, but now it required a PhD in accounting to understand how it worked. Now you needed lawyers. Now you needed to sit in rooms with Treasury officials and explain why your particular arrangement deserved particular treatment. Now the system was so complex that only the wealthy could afford to navigate it. The tariff system and the income tax system were built by the same people, or rather, by the intellectual descendants of those people. The machinery changed. The outcome did not. A railroad baron in 1880 used the tariff to protect his monopoly and subsidize his expansion. A banking family in 1930 used tax-deductible bonds and depreciation schedules and charitable trusts to achieve the same thing: growth, consolidation, control, while their tax burden shrank. Both men were wealthy. Both men shaped policy in their favor. Both systems redistributed resources upward while telling the public the opposite was happening. The income tax did not break the pattern of American financial power. It legitimized it. Because now the wealthy paid taxes. They just paid much less than the system's architects claimed they would. An income tax with a top rate of 70% sounds punishing, until you understand that through deductions and credits and structured losses, the effective rate was never close to that number. The tariff had been crude, a blunt instrument that everyone could see. The tax code became sophisticated, and sophistication is the friend of the rich. This is the shadow that the tariff cast forward into the 20th century. Not as a specific tax, but as a principle. The principle that government revenue could be raised in ways that the average person did not fully understand. Administered by specialists who answered to the wealthy, shaped by men who moved freely between private finance and public office. The tariff was America's first large-scale exercise in using government authority to funnel resources to private interests while maintaining the appearance of neutral economic policy. The income tax was the second iteration. Each time, the mechanism became more sophisticated. Each time, the architects learned something new about how to make it work without triggering the kind of public outrage that might force real change. The tariff trap, in other words, never closed. We simply stopped calling it that. We gave it a new name. We hired more lawyers to manage it. We created new institutions, the Internal Revenue Service, the Federal Reserve, the Securities and Exchange Commission, staffed by men who had spent their careers learning how the system actually worked, on the side that benefited most from it. So here is what you should take with you from this. The tax system that most Americans believe is modern and democratic was actually built by the people who benefited most from the tariff system it supposedly replaced. The names changed, the mechanisms grew more complex, but the fundamental architecture, a government that raises revenue in ways that concentrate wealth upward while claiming to serve the public interest, remained intact. Spend this week asking yourself a simple question: what parts of your own financial life are you managing based on visible information, and what parts are you managing based on things you have to trust other people to explain? That gap between what you see and what you do not, that is where the system works best. That awareness is where real understanding begins. Thank you for watching. If this kind of history matters to you, please subscribe to The Unseen Hand and hit that notification bell so you never miss when we upload. I would genuinely love to hear in the comments what part of this story shocked you most, or whether you have found evidence of these patterns in your own local history. See you next time.